The gold-silver arbitrage, or the price differential between East and West, has been exploited for millennia. From Venice, the Spanish Empire and the Bank of Amsterdam, which we've considered on the channel. But this arbitrage is actually being exploited right now, and we're paying for it twice over. Once via a suppressed silver price, and second through higher costs for green technology. Meanwhile, London, China and India prosper. But in relation to London, the real question to consider is how can a market be short of metal but rich in revenue? And how is the City of London Corporation to ensure that it continues its rent-seeking activities to profit from Eastern precious metal demand? After all, the city has long been the epicentre of precious metals trading. The East India Company depleted British silver money supply to export to the east and bring back gold to the west. Profit came here not from the bullion itself, but from pricing power. Financialisation means the same ounce can underwrite multiple claims, ensuring that prices reflect paper supply rather than the actual physical scarcity. Today's system demonstrates a reference price which is set in the West. That is largely a derivative construct, so the value is derived from the underlying asset rather than the physical possession of that asset. Thus, the real reference price is determined not by the vault, but by the clearinghouse. India and China have historically overvalued silver, using it as real money, while gold was generally used for religious or ceremonial purposes. Today, precious metals are not simply reduced to an abstract financial instrument. Instead, enabled by the BIS's Basel banking rules discussed previously here, and encouraged by deliberately misguided Western policy approaches, China, Russia and India are hoarding physical metal at the expense of US Treasury bonds. In the silver market, we've seen that manifest via financialisation and suppression, which inherently undervalues silver. The upshot has been a one-way flow of tangible wealth, where metal moves east and paper claims remain in the west. It's well known that Western futures markets, COMEX and the London Bullion Market Association operate on massive leverage, where hundreds of paper ounces are tied to one physical ounce of precious metal. While cartel confidence holds, contracts are rolled over. Retail investors buy ETFs and few actually demand physical bars. Yet the common narrative fails to address the close relationship that exists between London and the Shanghai financial cluster. For instance, the city has a dedicated China program with offices in Beijing and Shanghai, and often promotes its financial and professional services to Greater China. In March this year, the Lord Mayor of the City of London, Alistair King, signed a memorandum of understanding to embrace exchanges and cooperation between Shanghai and London in areas including financial markets, professional services, digital finance and offshore RMB business. Of course, London is the largest offshore RMB clearing hub outside China and is heavily involved in China's BRICS projects, as we considered previously. So we've seen Western stocks tighten, yet prices, you could argue, have remained relatively tame, thanks to the expansion of paper supply, where the financial system can create an illusion of relative abundance. But of course, the shortage narrative also coincided with the sell-off of these paper markets, given silver had attained a new relative high. Net zero madness amplifies silver demand, and this reinforces the drain of silver from its own shelves, while the BRICS continue their gradual de-dollarization and effective remonetization of gold and increasingly now silver. Each Western initiative to decarbonize effectively transfers more bullion and industrial value eastward. Meanwhile, the East benefits from both sides of the trade. It accumulates physical stockpiles and captures manufacturing profit. The West is actually reinforcing the valuation of silver as a strategic metal. But if you think that Western government policy and the City of London is actively working towards its own disintermediation from the metals market, well, I believe you're quite mistaken. So if there is apparently no metal, how does London profit? Well, within the City of London Corporation, there are effectively two Londons that we need to consider here. Trading London, which consists of the bullion banks, ETF issuers and derivatives desks that thrive on volume and relative price stability. It earns on spreads, fees and churn of speculative capital. But then there's London Infrastructure, which consists of the City of London as a legal and financial organism, which enjoys a far deeper and all-pervasive foundation in the global bullion market. It generates enormous profits, not from trading metal, but from owning the infrastructure of trade itself. It profits through its clearing houses, whether it's the ICE, LPMCL, or the LBMA, legal and custody networks, and the tax and regulatory frameworks that define global contract legitimacy. Recently, we've seen backwardation take place where the London spot price has exceeded the futures price in New York for silver. This represented demand for metal now rather than later. But unless they reach truly extreme level, London will continue to profit. Scarcity widens spreads, boosts clearing margins and accelerates ETF rebalancing. The East may hoard the bars, yet London can arbitrage on the apparent anxiety. Because even as tons of metal flow towards Asia, the contracts still clear under English law. Documentation templates, collateral agreements and arbitration clauses all route through London. You see, the City of London profits from scarcity or abundance. The less metal there is, the more contracts can be written to hedge, insure and litigate upon. So real profit is actually in the instruments for London rather than the inventory. For believe it or not, London's real export is its credibility. In the 19th century, this was via trade bills, but today it's through its derivatives and legal enforceability. China and India can buy, refine and store metal, but when they finance or swap it, they still rely upon London's frameworks for counterparty protection. The West's apparent physical scarcity does not threaten its profit, it actually sustains it. Now it's worth just considering this logic here in this short sharp table, where the East accumulates that physical metal following the logic of industrial demand and strategic accumulation. But the West focuses on paper but follows its own market logic of pursuing legal derivatives and infrastructure rents. Even as the shelves empty, the pipes are busier and more valuable than ever. Indeed, between August 2023 and August 25, London silver vaults fell by 2,700 tonnes. That's around 10%, but the clearing value soared by 70%, and gold vaults were up 0.6% and clearing 70%. And in the case of silver, the East then adds value to much of it, which can then be sold back to the West to focus upon the net zero infrastructure. The idea that London is losing control is appealing and seductive, but it lacks nuance. For while the East owns the bullion, London still writes the rules and collects the fees. If hubs in Shanghai, Mumbai or Dubai start matching or bypassing London clearing, not just physical custody, or they begin to develop legal credibility, that would really challenge London's dominance. Until then, not so. Now there's more to come on the ongoing exploitation of the gold-silver ratio, so please do consider subscribing and checking out the other videos on the channel. Thanks so much for joining me, and I look forward to seeing you next time. Bye bye.